All right, thank you everyone for joining today's webinar, 6 RCM Metrics Every Medical Practice Leader Should Know. If you have questions, please enter them in the Q&A panel and we will answer them at the end of today's session. Today's session is being recorded, so if you have any questions, those will be captured in the recording as well, but you will receive a copy of the recording a few days after today's webinar. So with that, today's speaker is Mark Minnie, Senior Director of RCM Client Management. And Mark, I'll pass it over to you.
All right, thank you very much, Lori, and welcome everyone. Thank you for joining. First off, I'd like to kind of introduce myself and why I am not necessarily an expert, but why I'm speaking to you today about RCM metrics. So I am, as Lori mentioned, the Senior Director of Client Management. My role is to work with our existing revenue cycle clients, and we offer revenue cycle services to those clients. So I am very much in the weeds with processes, workflows, technology, and for today's presentation, the overall metrics. So in addition to looking at our metrics for the practices, we're also going to start at a very high level review of the revenue cycle. And the reason that that's important is we have to know how these metrics can be plugged into the revenue cycle to have that impact on our workflows. So starting out, it's very simplified, but you can see our high level view of what that revenue cycle looks like. And we're going to take a little bit more in-depth view at each one of these steps, but this just gives us that quick snapshot. Starting out with that patient registration process. So this is that one chance you have with the patient prior to seeing the doctor to get all of the information that you need to be able to submit a clean claim to the payers. And by the time the patient leaves the office, you really lost any opportunity to gather any additional information. The claim submission process is hopefully an automated process, or as automated as you can make it with your practice, to be able to pick up those claims, make sure that coding is accurate, and that you can get those claims out to the payer. After the claim submission process, this is really like you're sending that claim to college now, and you have your fingers crossed, and you want to make sure that you've really done everything you can with that claim. But in the event that claim comes back denied, or we don't get that original that payment as expected, then we go through our denial management workflow. So this is where we're going to pick up based on those denial reason codes and take appropriate steps in order to get that claim back out. The AR management piece, in addition to following up on claims that we haven't received a denial on, we also include in the AR management process things like sending statements to the payers. If you do have phone calls being made to the payers, then this would all fall within that step. And then finally, a step that can't be forgotten and is very important and really includes all of these metrics is the analysis phase. So this is where you can truly get into the individual metrics and make sure that everything's operating smoothly, that your denial rate is not too high, that claims are going out, and that payments are being received as expected. The question comes up, why is it important to understand our revenue cycle, and why is it important to operate efficiently within the workflow? So starting out at the top left, we can see it's on average $25 to rework claims. So that's full rework. Actually, on average, it's about $12 just to figure out why a claim denied. So the work that you're paying for to have your business office go in and rework a claim has a huge impact. And you can see that by minimizing denials as much as possible, you'll actually be able to save quite a bit of money for your practice. Second one on the top right there, so 50 to 60% of denials are never worked. This is a huge percentage, and this is a ton of open AR that it can be essentially rebuild out to payers with the appropriate corrections, and then you could get payments on those. So it's a very large opportunity. Bottom left, 90% of claim denials are preventable. So what we're looking at are the eligibility related, the demographic related. If it's something where coding is just not accurate, these are all opportunities to maximize that revenue on a clean claim. So why is it important is because without the visibility and without being able to see how these metrics fluctuate, then we really don't know where to designate our time. We don't know where to put additional resources or add technology. And that gets into why that executive level involvement is important. More often than not, what I see is that sometimes the dots just aren't connecting. So you may see that you have a business office team that's working behind the scenes to make sure that those claims are getting out appropriately. You probably have a team that's posting payments, and then probably another patient AR team that's following up on those claims. And what each team might not be doing is communicating what types of denials we are receiving, where we're having to focus additional work efforts. So the role here of the executive is to make sure that we are connecting all those dots. So if our back office is seeing something that can be improved with our front office, let's say eligibility related denials, then you have that opportunity to connect those dots. If it's additional training, if it's a process problem, that can be fixed. If it's additional technology, then that also can be fixed. All right. We're going to go, I mentioned, into each one of these stages of the revenue cycle a little bit more in depth, starting out with our patient registration. I have heard it from multiple people, and I tend to agree with it, that the front desk, and so you could argue, should be the highest paid individuals at your practice. And the reason I say that is there is a huge impact that these individuals have on that downstream revenue cycle. You want to make sure that insurance information is being captured and captured appropriately. By running eligibility checks, you can ensure that we're not going to see those denials after the fact and then have to rework and submit those claims out to the payers. By making sure patient information is also accurate, we're going to be able to ensure that if we have not collected a payment at the front, that we can get statements out to payers. Or also, we're also going to be able to avoid any denials coming back for those. And then our last bullet point there, the copay collections, is I have always heard this is your one chance to get a payment before the patient leaves the office. And by the time the patient leaves, our likelihood of getting paid on that claim drops significantly. So by collecting copays at the front desk, it's a skill that has to be taught. It's not something that always comes natural, asking for payments, but it is a skill that, if done effectively, can drastically increase those collections for the practice. Okay, and then our second phase is that claim submission. So I mentioned that the patient registration section is the last chance you have with the patient to be able to collect copays or get any information from the patient coming out. Well, this claim submission section is really your last chance to have an impact on the claim before that claim makes it to the payer. In order to optimize this section of the revenue cycle and make sure that claims are going out appropriately, we'd really recommend putting in the appropriate edits, whether it be claim production edits in NextGen. If you utilize a clearinghouse that's able to set up edits, then that's another opportunity to be able to stop claims before they get to the payer. Or you have the opportunity to use additional tools like the NextGen charge review rules engine. Makes automatic fixes to claims for scenarios that you know need to be fixed 100% of the time. And what that tool can do is it actually eliminates steps that that your team is having to correct prior to the claim being billed. So if it's modifiers that need to be added 100% of the time, if you have to make updates to providers that are going out on the claim that you know are going to happen on every single occasion, then these are your opportunities to make those updates prior to that claim being billed. All right, and if we realize that we did not get any of the or all of those updates completed, or if it's a denial that is truly unavoidable and not preventable, then we're going to receive that denial on the back end and eventually need to work that claim. This is where it becomes so important to minimize that denial rate so that we are receiving as few denials back, and we're also preventing those denials that truly are preventable. What's important when we're looking at denial management is the overall denial trends. So when I say trends, there are multiple reportable fields in NextGen you can actually look at to see if we're seeing any spikes in certain denial reasons. You can look to see if you have any spikes with certain providers. So if you do have a provider that has a higher denial rate than other providers, you can run reports on that and be able to see those denials. You can also catch things like locations, or if you use any type of subgrouping or departments, then those are other areas where you can trend out those denials. Our next opportunity is there is the turnaround time on working those denials. So this is something that we monitor very closely for clients that we work with. We expect that we are having a quick turnaround time from when that denial is posted to when we're getting that claim back out the door. I mentioned that 50 to 60% of denials go unworked, and you can track that type of information and make sure that those denials are being worked by your practice. And then the important step here, and we're going to come back a little bit to the feedback loop, but is making sure that we're providing that feedback. So if we do have an avoidable denial, one that is preventable, we want to make sure that the information is making it to the appropriate teams. And a lot of times that's where your role as an executive comes into play. Okay, and then we get into our open AR. This is going to be not only following up with the payers, but also following up with the patients. In order to have effective processes, we want to make sure that that we are checking open AR. So if we haven't received a denial, then we need to set those follow-up timeframes accordingly to capture any open AR to get claims rebilled to payers, and then eventually follow up until we get payment. And the second process, or the second part of that open AR, is our patient collections. So checking to make sure that things like statements are going out. If you're making calls to the patients, making sure that those calls are being done timely. And then finally is either a bad debt or a collection process. So if we realize that the open patient AR is uncollectible at a certain point, or less likely to be collected, then we highly recommend having a collection process. This can really save costs tied to statements going out. So if you're sending, you know, your 5th, your 10th, your 15th statement out to a patient, then at that point, those are sometimes unnecessary costs. And the final step that often gets forgot is that analysis. So we have a great tool, NextGen Financial Analytics, that we can that we utilize a lot, and it gives us that in-depth look to see where we are trending with our metrics. So if we are exceeding our targeted goals in terms of collections, also if we're, you know, higher than normal on things like denial rate or open AR, then we can capture that quickly, and we can provide feedback based on the summaries that we put together. Now, this gets into actually understanding the metrics, and it starts out very basic with our charges, payments, adjustments. I think most people tend to understand all three of these metrics, but where I see that that sometimes the understanding is not there, or that we're not actually getting to the point of understanding when we expect our charges, payments, and adjustments to both increase or decrease. So as we're looking at all three metrics, you can see that we've got an AR impact calculation there. So when we're looking at AR month over month, just because we're in the month of June, we'll be looking at our AR impact for June at the end of this month. So in order to calculate that, I'm going to look at our open AR from the beginning, or excuse me, from the end of May. We'll add in our add in our payments, subtract out payments and adjustments, and add in those refunds to understand what that AR impact is. This is a field that is not necessarily a good or a bad thing if you see that AR impact increase. So things that would cause that AR impact to increase are if you have new providers or new locations to the practice, if you made a recent acquisition and your practice has grown significantly, then we would expect to see charges increase, and we're not always going to see those payments and adjustments follow during that first month. There are other chances, opportunities where we're going to see that AR impact decrease when it's not always a good thing. So, if we've seen that charges were down significantly in a month, let's just use a lot of the COVID impacted months are great examples of that. So we saw charges drop off significantly, and our payments and adjustments actually remained high for the first month or 2 months, because we were able to collect off a lot of the open AR for those first 2 months. What we're going to do is we're actually going to take a look at an example of a question that I get all too often. So the question that I get is, Mark, our charges were up for the month. Our payments were not up for the month, and we need to understand why that is. So the example that we have below, if you look at the left side of the screen, you can see that for the month of July, we had charges at 1.986 million. And then for the month of August, we can see that we were about 44,000 less in charges in August. As we look to the right, we can see on that same chart, payments for July, even though charges were higher, not by a large amount, but by a small amount, payments for July were actually significantly lower than our payments for August. As I mentioned, this is a question that I get asked all the time, and this is why I think it's important to not only understand high-level charges, payments, and adjustments, but also to understand the true impacts that we're going to see. So if we look at the screen to the right in the red box there, the weeks that I have highlighted, so you can see that this is looking at our metrics by week. The weeks that I have in that red box are those weeks that are likely going to be collected in the month of August. If we've got a 2-week turnaround on getting those payments, then it's much more likely that we're going to get paid on those 4 weeks during the month of August. So when we look at the 4 weeks of charges during that red box, and if we were to compare it to the 4 weeks prior to that red box at our charges, we can actually see that the charges are significantly higher by week, and we can see weeks that are $100,000 to $200,000 higher in terms of those charges. Now, in turn, we can see that our payments during the month of August, so if we were to look at the week of August 1st through the week of kind of end of the week of August 22nd and very beginning of the week of August 29th, we can actually see that those are some of our highest payment weeks. So one thing to understand after this presentation is looking at that high level charges, payments, and adjustments doesn't always give us the great snapshot that we need, and it requires just a little bit more of an in-depth review. Okay, and that leads very nicely into our lags. So the reason that we're not getting paid on those charges from the same month is because we've got lags involved. We've got our charge lag, which is going to be from our date of service to our charge creation date. So however much time it takes providers to sign off on reports, for the coders to go ahead and pull those charges over into PM, that's going to be our charge lag. Our encounter billing lag is going to be the date from when those charges are processed to when we actually bill. So this time frame is often going to include things like claim edits. So if you are using claim edits, which we highly recommend, the turnaround time on working those claim edits and getting those claims back out the door is going to have an impact on that encounter billing lag. The other reason that this field is, or excuse me, that this lag is important is if you see any spikes or increases in your billing lag, I would highly recommend raising that red flag immediately because there might be an issue where claims aren't being billed out as expected. And then finally, our payment lag. So this is one that you're going to have less impact on. The reason that is because we're looking at first bill date to first payment process date. And this payment lag is often tied to turnaround times with the payers. So this is going to be how quickly your payers can process those claims and get those claims paid. And to look at it just a little bit differently with a friendlier visual on the eyes, we can see that each one of our lags picks up after the one that precedes it. So our charge lag starts at that date of service. We follow that through to our charge process date. From there, once we hit that charge process date, that's when we start our encounter billing lag, and that follows it through to our first bill date. And then once we hit that first bill date, that's when we start our payment lag and move on to our payment process date. Okay, so our second metric, or excuse me, not second because we looked at charges, payments, and adjustments, but our fourth metric we're looking at is our days in AR. This is one that I often hear many practice administrators, CEOs, CFOs looking at is our days in AR because we want to understand the impact of why our days in AR are increasing or decreasing. So we're starting out with the definition. This is how many days it takes the practice to collect on payments due, and it's an overall average. So in order to calculate that, for one snapshot in time, we're looking at your total AR, and we're going to divide that by the average daily charges for 3 months. So more often than not, when you're looking at days in AR, you're looking at days in AR for the previous 3 months. It's a little bit less common to look at days in AR midway through the month, but you can do it if you want. So when we're looking at 3 months worth of data, I put a comment in here to double check your days in AR calculation, because if you're getting provided this information, it's not uncommon to see 3 months always calculated as 90 days. So taking your 3 month daily, or excuse me, 3 month charge total and dividing it by 90 days to get that average of 3 months. I personally recommend against that process. I would recommend looking at the actual number of calendar days. So if you've got 2 months during that 3 month time frame that have 31 days, I do recommend making that instead of 90 days, 92 days. Now this is a small change, but when you're tracking days in AR on a monthly basis, and that's one of your main metrics that you're tracking, you can see that this difference can be a day. It could be less than a day. But if you are very low in your days in AR and you're getting quick payments, then even those small impacts can affect those metrics. Now, how do we understand the impacts to our days in AR? So we're looking at, as I mentioned, average daily charges and looking at the total AR. So in a perfect world, if we've got our average daily charges and it's the same number of charges that are entered every day for the same amount, then it's going to make predicting where we're going to finish each month and predicting those days in AR much easier. But because that's not always the case, we actually have to take into account a lot of the impacts and be able to explain those changes to days in AR. So the example that I'm going to use is when COVID hit, and we saw for a lot of practices that charges were down, and it was a significant drop in charges. So what occurred during those months is because charges were down significantly, especially the first month, which was around April of 2020, we saw that there was a significant drop in our total AR because we didn't have charges going into the system. Now, the previous 2 months worth of charges were processing through our normal revenue cycle. Denials were being followed up on. But because we saw such a significant drop in our AR, we actually saw days in AR skyrocket. The reason is because our average daily charges do not drop at the same rate. So when when our charges fluctuate, then we're going to see impacts like that. Another impact to your days in AR, so we already talked about charge lags a little bit, is if you are a practice that gets all your charges in before the end of the month, I would recommend looking at that process a little bit closer. And the reason I say that is there's something called a cliff day each month, and that's going to be the last day that you can enter in charges and bill those out to the payers and still expect to get payment. So the reason that we calculate that cliff day, and we can actually calculate it by payer, is because we want to know when's that last day or that cliff day where we can bill out charges to the payers and still expect to get payments that same month. If you do push a lot of those charges in at the end of the month, what you're going to see is you actually carry a little bit of that impact on those days in AR. All right, and then we're looking at our denial rate. So the way that we calculate our denial rate is by looking at our total denial amount and then dividing that by our total charge amount. Or another way of looking at it is our total denial count divided by our total charge count. And both pieces of information are extremely valuable. So for the CFOs out there, you're likely looking at our denial rate as an amount compared to our charge amount. But for those of us that are working the denials, we often like to pay attention to the count. And the reason I say that is because if we are on average having to pay $25 for follow-up on claims, and when we're looking at total production for a business office, we want to be able to identify how many accounts someone can work in a day so that we can figure out how many people need to be working those denials. The feedback loop at the beginning, and this really ties everything together. So on the left side, we can see that same high-level revenue cycle process that we follow, starting out with patient registration. We move into claims submission. After that, we've got denial management, AR management, and our analysis. And the feedback loop is really providing the information in an opposite order. So all of those arrows are switched, but basically it is, if you have a denial team, you need to make sure that they are providing the information on what denials are being received back to that front office team so that you're reducing those denials. And really our analysis of the revenue cycle, even though it's pointing back to AR management, when we're analyzing and when we're looking at these metrics, the feedback should be going to all teams because we want to make sure that we're optimizing our processes. All right, so the call to action really is making sure that you're understanding those metrics. I know today we just looked at 6 number of different metrics that can really assess that performance. And in addition to understanding these 6, you can really dive into supporting metrics. So metrics that will help explain these 6 and help us understand if we're running an optimized process or if there's opportunity. So in addition to knowing those KPIs or knowing those metrics, it is so important to understand the formulas that go into it. I think a lot of times we get caught up in just looking at, oh, we went up or we went down. And without understanding those formulas, we can't really connect all of the dots to be able to explain our month-end performance. Last call to action is really to develop that feedback loop. So make sure that in addition to providing feedback to your business office, you're providing it to the front office, you're providing it to the providers because they have a large impact on things like charge lag and making sure that we're not receiving those denials. So that's my challenge to everyone that's listening. And on that note, I will actually pause for a second, and Lori, I will turn it to you for any questions.
Thank you so much for that information. So if you do have any questions at this time, you can enter them in the Q&A panel. We did have a couple questions about receiving the presentation and the recording. So You will receive both a copy of the presentation and the recording a couple days after the webinar today. But if you have any other questions, now is your time to ask them. All right, looks like we don't have any right now, but we'll give it a second or two and see if anyone has any. Otherwise, we'll end it and hope everyone has a great day. And if you guys have any questions that come up later, you can always just reach out to your account manager or your account executive here at NextGen and ask them the questions, and they can connect you directly with Mark if it's specific to something about his presentation. All right, so it doesn't look like there's any questions. So thank you, Mark, so much for your time today. If anyone does have any questions, like I said, please feel free to reach out to your account manager. You can visit our website at www.nextgen.com, and I hope everyone has a great day. So thank you so much. Bye.